What is the first thing you look at when you consider buying a stock? Be honest with yourself. For nearly every person on Earth, the answer is the same: the price. You see the ticker, you see the number next to it, and you see the little red or green arrow showing where it's been. This single piece of data, this flickering number on a screen, becomes the sun around which your entire analysis orbits. You judge whether it's expensive or cheap based on where it was yesterday, last month, last year. You read articles and watch news reports that frame their entire narrative around the price's movement. And with that single, seemingly innocent glance, you have already lost the game. You have walked into a psychological trap set by the market, a trap that ensures you will, over the long term, make emotional, irrational, and costly decisions. You have anchored your entire thought process to the one piece of information that tells you the least about the investment and the most about the temporary mood of a fickle crowd. There is another way. A method so simple in its description and so profoundly difficult in its execution that it has been the unshakable foundation of the greatest fortune ever built through investing. It is a two-step process, an iron law of financial discipline practiced by Warren Buffett for over 70 years. First, you analyze the business as if it were a private company you were considering buying in its entirety. You dig into its financials. You understand its competitive position. You project its future earnings power, and you calculate for yourself what you believe its actual underlying worth is, its intrinsic value. You do all of this in a self-imposed quarantine, a state of deliberate ignorance where you forbid yourself from knowing the current stock price. Only after you have arrived at your own independent number, a value you can defend with logic and reason, do you perform the second step. You lift the veil. You look at the stock price. And in that moment, the market is no longer your guide. It is your servant. The price is not a measure of truth. It is merely an offer. It is the price tag on an item for which you have already determined the value. And you only act when that price tag presents a significant discount to your calculated value. This is not a clever trick. It is a fundamental reordering of the investment process. It is a psychological shield. By valuing the business first, completely independent of its market quotation, you protect your mind from the most powerful and insidious cognitive bias in all of finance: anchoring. The stock price can no longer contaminate your analysis, because your analysis is already complete. It cannot trick you into believing a popular, overhyped company is a good buy simply because its price is high and rising, nor can it scare you away from a solid, profitable enterprise whose price has been beaten down by temporary fear. This discipline transforms you from a price taker, a passive reactor to the market's whims, into a business appraiser, an active arbiter of value. It is the core secret to never overpaying. It is the key to building the unshakable conviction required to buy when others are panicking and to patiently hold when others are chasing fads. It is the engine that creates a true margin of safety, the buffer that protects you from the inevitable errors of a future you cannot predict. What you are about to learn is not another stock-picking tip. It is a permanent upgrade to your mental software, a transformation in financial discipline that will change the way you look at every asset for the rest of your life. The entire architecture of modern financial media is designed to make you fail at this. It is a constant screaming siren of price action, of daily winners and losers, of targets and predictions, all centered on that flickering number. To resist it requires an act of will, a conscious decision to build a different process. It begins with creating an iron curtain of ignorance. This is the first and most crucial pillar in the Buffett method. It is the deliberate, strategic act of blinding yourself to the market price while you do the real work of stock valuation. This isn't about being uninformed. It's about being selectively, intelligently ignorant. It's about creating a sterile, clean room environment for your brain, free from the cognitive pollutant of the market's opinion. Because the market's opinion, expressed through the price, isn't an analytical tool, it's a psychological weapon. It frames your thinking before you've even begun. If you see a high price, you subconsciously start looking for reasons to justify it. If you see a low price, you start looking for hidden flaws. Buffett understood that to think clearly, you must first build a wall between your analysis and the crowd's emotion. A perfect illustration of this discipline in action, a moment where the pressure to anchor to a seller's price was immense, can be found not in the stock market, but in a private transaction that would become a cornerstone of the Berkshire Hathaway empire. The year was 1972. Warren Buffett and his partner, Charlie Munger, were presented with an opportunity to buy a company called See's Candies. It was a beloved, family-owned California institution, famous for its high-quality boxed chocolates. The business was a gem. It required minimal capital to operate, generated prodigious amounts of cash, and had a fiercely loyal customer base that allowed it to raise prices year after year without losing business. A classic Buffett-style moat. Buffett and Munger did their work. They analyzed the books. They understood the brand. They calculated what they believed the business was truly worth, based on its earnings power and its future prospects. They arrived at a firm valuation in their own minds. This was their number, born of pure fundamental analysis. The sellers, the See family, also had a number. They wanted $30 million. Buffett and Munger, based on their independent valuation, felt the absolute maximum they could pay was $25 million. That $5 million gap was a chasm. The seller's asking price was the anchor, a powerful one, especially in a face-to-face negotiation for a unique, unlisted asset. The temptation for most people would have been to meet in the middle, to split the difference, to let the seller's anchor pull their own valuation upwards. But Buffett and Munger operated under a different set of rules. Their $25 million valuation wasn't a starting point for negotiation. It was a conclusion derived from their analysis. The seller's price of $30 million was just noise. It was an offer, not a fact. The negotiation was tense. At one point, Buffett and Munger walked away. They were willing to let this phenomenal business go rather than violate their own discipline and overpay. The story goes that the intermediary, a man named Ira Marshall, had to frantically convince the See family to reconsider. Ultimately, they relented. They accepted the $25 million offer. That single act of financial discipline, of refusing to be anchored by the seller's asking price, has since paid off in a way that is almost impossible to comprehend. See's Candies has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all of which has been available for Buffett to reinvest elsewhere. That initial $25 million investment has returned, so far, 80 times over, not counting the compounding of the profits that were reinvested. Had they given in to the anchor, had they paid $30 million, their returns would have been significantly lower, but more importantly, they would have broken their own process. They would have allowed someone else's number to contaminate their own judgment. The iron curtain of ignorance held firm. They valued the business first, and only then did they compare their value to the price being offered. The price was a hurdle to be cleared, not a magnet to be drawn toward. The deep psychological principle at work here goes beyond simply avoiding a single bias. It's about achieving a state of what we can call cognitive purity. Think of your mind as a laboratory where you are conducting a delicate experiment, the valuation of a business. Any external data that isn't directly related to the business's fundamental operations is a potential contaminant. The stock price is the most potent contaminant of all. It doesn't just sit there benignly. It actively frames your perception. This is because our brains are not rational calculating machines. They are narrative machines. When we see a stock price of, say, $500 for a popular tech company, our brain doesn't just register the number, it instantly begins to weave a story. This must be a great company, it says. Look how successful it is. Look how many people are willing to pay this price. I need to find the reasons why this high price is justified. Your entire subsequent research process becomes a confirmation exercise, not an exploration. You are no longer a detective seeking the truth. You are a lawyer, building a case to support a pre-existing conclusion handed to you by the market. This is the path to ruin. Achieving cognitive purity means you are building your case from first principles, from the ground up, using only the raw material of the business itself, its revenue, its expenses, its assets, its competitive landscape. Your valuation is your story, your narrative, built brick by brick. The stock price is someone else's story, a messy, emotional, often nonsensical epic written by millions of strangers. By refusing to read their story until yours is finished, you preserve the integrity of your own plot. This discipline is the ultimate defense against the madness of crowds. The market can be in a state of euphoric mania or depressive panic, but inside your sterile cognitive environment, none of that matters. You are immune to the emotional contagion because you have shut the door. You are not smarter than the market, but by following this process, you can be more disciplined and more rational. You are insulating your judgment, which is your most valuable asset in the entire investment process. So how do you, as an individual investor, translate this powerful concept into a concrete, repeatable action? You build a system, a mental model that becomes a non-negotiable ritual. We will call it the Valuation Dossier Blueprint. This is a step-by-step process you must follow before you are allowed to even look at a ticker symbol's price. Step 1. Identify a potential company through a price-agnostic method. This could be from reading a trade journal that highlights an interesting business, observing a product you love, or screening for companies with specific financial characteristics like high returns on capital, but crucially, not by looking at a list of top-performing stocks. You are looking for a business, not a stock. Step 2. Create a new blank folder on your computer. Name it after the company. This is your sterile laboratory. Step 3. For the next week, your mission is to populate this folder with nothing but raw, fundamental data. Go to the company's investor relations website. Download the last 5 years of annual reports, the 10K filings. Download the last 8 quarterly reports, the 10Q filings. Read the CEO's letter to shareholders for each of those years. This is your primary source material. Do not read analyst reports. Do not read news articles about the stock. You are only permitted to read the direct communications from the company itself. Step 4. As you read, begin to build your dossier. Create a spreadsheet and manually type in the key numbers yourself. Revenue, net income, cash from operations, debt levels, share count. The physical act of typing the numbers burns them into your brain in a way that just looking at them never can. Create a text document where you summarize, in your own words, what the business does. Who are its customers? Who are its main competitors? What gives it an advantage, if anything? What are the biggest risks it faces, as stated by the management themselves in the risk factors section of the 10K? Step 5. After you have saturated your mind with the company's own data, you are now allowed to seek out high-quality, independent analysis of the business and its industry, but still not the stock. Read industry reports, deep-dive articles from reputable business journals, or books about the company's history. Your goal is to understand the ecosystem in which the business operates. By the end of this process, which could take days or even weeks of patient work, you will have a deep, intimate understanding of the enterprise. You will have built a story, a thesis, in your mind. Only then, after all this work is complete, have you earned the right to proceed to the next phase, the actual stock valuation. But the key is that you have done all of this, the most important part of the entire investment process, behind the iron curtain of ignorance. The price is still a mystery to you, and because it is, your analysis remains pure, unbiased, and truly your own. Now let's contrast this with the well-trodden path of the 99%, the path of almost certain mediocrity or failure. This is the path of price-led justification. It starts, as it almost always does, with the price. An investor hears a tip from a friend or sees a stock mentioned on a financial news network. Quantum Core AI is the future. It's up 200% this year. The first thing they do is pull up the stock chart. They see a beautiful soaring line moving from the bottom left to the top right. This visual anchor is overwhelmingly powerful. The price is high and going higher. The story is already written. This is a winner. The investor is now experiencing a potent cocktail of psychological biases. Social proof, everyone else is buying it. Fear of missing out, I need to get in before it goes even higher. And now, anchoring. The current high price seems normal, even reasonable. Their entire subsequent research process is not a process of discovery, but a frantic search for confirmation. They Google the company. They skim headlines that reinforce the positive narrative. They look for analyst reports with high price targets. They ignore any negative information, dismissing it as FUD, fear, uncertainty, and doubt. They are not analyzing the business. They are looking for permission to do what their emotions are already screaming at them to do: buy. They might glance at the price-to-earnings ratio, but they don't understand what it means. They might see the company is losing money, but they'll tell themselves a story about investing for growth. They have completely inverted the Buffett method. They started with the price, and then they reverse-engineered a justification for it. They are a passenger on a ship, being piloted by the market's mood, and they have no idea where the ship is truly heading. This is why the average investor dramatically underperforms the market over the long run. They buy high in a state of euphoria, and they sell low in a state of panic, because their entire framework is built on the flimsy foundation of price, not the bedrock of value. The direct financial connection here is profound and immediate. By adopting the iron curtain of ignorance, you are playing a completely different game from the 99%. Your first act is one of capital preservation. The biggest financial mistake an investor can make is a permanent loss of capital, and the easiest way to suffer that is by overpaying for an asset. Price-led justification almost guarantees you will overpay for popular, exciting stocks at the peak of their hype cycle. You are essentially paying for a good story, not a good business. This leads to what economists call the winner's curse. In an auction, the winner is often the person who most overestimates the value of the item being sold. The stock market is a giant, continuous auction, and by anchoring to a high and rising price, you are setting yourself up to be the cursed winner, the one left holding the bag when the story changes and the price collapses. The iron curtain of ignorance protects you from this fate. It forces you to be a business analyst, not a market speculator. Your initial focus is on the earning power and durability of the business, not the fleeting sentiment of the crowd. This means your entry point, if you decide to invest, will be based on a rational calculation of worth, not an emotional reaction to hype. It sets the mathematical foundation for your future returns. Buying a great business at a fair price can be a good investment. Buying a great business at a wonderful price, a price discovered through disciplined, independent work, is how fortunes are made. This first pillar, this act of willed ignorance, is the gateway to that entire process. It doesn't guarantee you'll be right, but it guarantees that your conclusions will be your own, free from the dangerous contamination of the market's madness. It's the first step on the path to true financial independence. Once you have sealed your mind behind the iron curtain, once you have committed to ignoring the siren song of the stock price, you are faced with a new, formidable challenge: the art of the independent appraisal. This is the second pillar. If you are not using the market's price as a guide, you must create your own guide. You must become a business appraiser. You have to answer the question, what is this business actually worth? This is the core activity of value investing. It is the deep, intellectual work of fundamental analysis that separates investors from speculators. It is the process of building, from the ground up, a rational, defensible estimate of a company's intrinsic value. This is not about finding a precise number down to the last penny. It's about coming to a reasonable range of what a prudent business person would pay for the entire company if it were for sale as a private entity. It's about looking at a publicly traded company through the lens of a private owner. And there is no better example of this principle in action than Warren Buffett's transformative investment in the Washington Post. In 1973, the stock market was in a foul mood. The Nifty 50 bubble had burst and investors were fleeing from stocks. The Washington Post Company was a publicly traded entity, but the market despised it. Its stock had been crushed, falling by nearly half. On the surface, looking at the stock chart, it looked like a disaster. The price anchor was low and sinking, screaming danger to the 99%. But Warren Buffett, operating behind his iron curtain, saw something entirely different. He wasn't looking at the stock, he was looking at the business. And the business was magnificent. He saw that the Washington Post was not just a newspaper, it was an institution. It held a dominant, near-monopolistic position in a major American city. It had immense pricing power with advertisers. It owned Newsweek magazine and several valuable television stations. Buffett completely ignored the stock's terrible recent performance. That was just Mr. Market in one of his depressive fits. Instead, he did the work of an independent appraiser. He asked himself, what would I pay for this entire collection of assets if it were a private company? He calculated that the entire company was being valued by the stock market at around $80 million. But then he did his own analysis. He estimated that just the television stations alone were worth more than $80 million. This meant that by buying the stock at the current price, he was effectively getting the dominant Washington Post newspaper, Newsweek magazine, and other assets for free. He saw that the business was earning around $10 million a year, and that this earning power was durable and likely to grow. His private appraisal revealed a staggering disconnect between price and value. The market was offering to sell him dollar bills for 40 cents, so he acted with conviction. Over the course of 1973, Berkshire Hathaway invested nearly $11 million to acquire a large stake in the company. That $11 million, anchored in a deep understanding of the business's intrinsic value, would become one of the greatest investments of all time. By 2007, that stake was worth over $1.5 billion. It was a more than 100-fold return, a testament to the power of valuing the business first. He didn't need the market to tell him it was a good investment. His own deep, fundamental analysis and independent appraisal had already proven it. The falling stock price wasn't a warning sign. It was a screaming opportunity, visible only to those who had done the work to know what the business was truly worth. The psychological principle that underpins this pillar is what can be called competence confidence. This is not the blustering, unearned overconfidence of the novice. It is the quiet, deep, and resilient conviction that comes from having done your own work, from having built your case from first principles. When you simply adopt someone else's opinion, whether it's a TV analyst's price target or the market's current price, your conviction is brittle. The first sign of trouble, the first scary headline or market dip, will shatter it, because it was never truly yours to begin with. It was borrowed confidence. But when you have spent 20 hours reading a decade's worth of annual reports, when you have built your own financial model, when you have written out your own thesis for why this business will be earning more money in 10 years, you develop a different kind of confidence. It is earned. It is robust. This competence confidence acts as a psychological anchor, but a healthy one. It's an anchor to your own analysis, not to the market's fleeting price. It allows you to see a falling stock price not as a threat, but as an opportunity to buy more of a wonderful business at an even better price. It's the emotional fortitude that allowed Buffett to pour money into the Washington Post when everyone else was running for the exits. This process is the antidote to the Dunning-Kruger effect, the cognitive bias where people with low ability at a task overestimate their ability. A superficial analysis, the kind prompted by price-led justification, leaves an investor at the peak of Mount Stupid, feeling confident but being dangerously incompetent. The hard work of deep fundamental analysis forces you down into the valley of despair, where you realize how much you don't know. But then, as you continue the work, it allows you to climb the slope of enlightenment towards true earned expertise, and the competence confidence that comes with it. So how do you actually do it? How do you build your own independent appraisal? Here is a practical, applied mental model for a simplified stock valuation, the blueprint for intrinsic value. It's a three-part process. Part 1. The qualitative analysis. This is the story of the business. Before you touch any numbers, you must be able to answer, in simple sentences, what Benjamin Graham called the central questions of investment. First, what is the company's moat, its durable competitive advantage? Is it a powerful brand like Coca-Cola? Is it a low-cost producer like Geico? Does it have a network effect like American Express? If you cannot identify a strong, sustainable moat, you should probably stop right there. Second, is the management team both able and honest? Read their shareholder letters. Do they speak plainly? Do they admit their mistakes? How do they talk about capital allocation? You are looking for managers who think like owners. Third, what are the long-term prospects of the industry? Is this a growing industry, or is it in terminal decline? No matter how good the jockey is, it's hard to win a race on a dying horse. This qualitative work provides the essential context for the numbers. Part 2, the quantitative analysis. Now you translate the story into numbers. While there are many methods for stock valuation, a simple and powerful one is to estimate the company's owner earnings, a concept Buffett popularized. This is roughly the company's reported net income, plus non-cash charges like depreciation and amortization, minus the average annual amount of capital expenditures the business needs to maintain its competitive position. This owner earnings figure is a good proxy for the real cash the business generates for its owners each year. Once you have a conservative estimate for this number, you can treat the stock like a bond. If a business consistently generates $10 per share in owner earnings, and you believe it can do this for many years to come, how much would you pay for that stream of earnings? If you want a 10% return on your money, you'd pay $100 per share. If you want a 15% return, you'd pay about $67 per share. This simple earnings power value approach gives you a solid, conservative baseline for the company's intrinsic value. Part 3. Establish a range of values. Acknowledge that the future is uncertain. Intrinsic value is not a single, precise number. It is a fuzzy range of probabilities. Therefore, create 3 scenarios. A conservative case, if things go poorly, a base case, if things go as you expect, and an optimistic case, if things go very well. Your true estimate of intrinsic value lies somewhere in that range, weighted toward your conservative case. This entire process forces you to think like a business owner. It grounds your decision in the economic reality of the company, completely divorced from the chaotic noise of its stock price. Now let's look at the antithesis, the path of the 99%. They do not engage in this deep, patient work. Instead, they rely on what we can call metrics as proxies. They use simple, readily available numbers as a shortcut, a substitute for genuine understanding. The most common of these is the price-to-earnings, or PE ratio. An investor will see that a company has a PE of 15 and conclude it is cheaper than a company with a PE of 30, but this is dangerously superficial. The company with a PE of 15 might be in a dying industry with a mountain of debt and dishonest management, while the company with a PE of 30 might be a dominant, fast-growing business with a huge moat and brilliant capital allocators. The PE ratio, in isolation, tells you almost nothing of value. Other popular proxies include the dividend yield, analyst price targets, or moving averages on a stock chart. Each of these is a step removed from the underlying business. Relying on them is like trying to understand a person's character by only looking at their height and weight. It's a shallow, incomplete picture that often leads to disastrous conclusions. The investor who relies on these proxies is outsourcing their thinking. They are allowing a simple metric or an analyst's opinion to do the work for them. This leads to a portfolio of stocks they don't truly understand, and when the market turns, they have no foundation of confidence to fall back on. They panic because their entire reason for owning the stock was based on a superficial proxy that has now turned against them. This is not an investment process. It is a recipe for being whipsawed by market sentiment. The direct financial connection of mastering the art of the independent appraisal is the very engine of outperformance. Beating the market over the long term is not about luck or clairvoyance. It is the systematic, repeatable process of identifying discrepancies between a company's market price and its underlying intrinsic value. Your financial success as an investor will be determined by the accuracy of your valuations and the discipline with which you act on them. When your fundamental analysis tells you a business is worth $100 per share and the market is offering to sell it to you for $50, you have a clear path to a 100% return, provided your analysis is correct. The hard work you do in the appraisal phase is what gives you the conviction to make large, concentrated bets when these opportunities appear. Most investors spread their money thinly across dozens of stocks they barely understand, hoping that a few will go up. The professional value investor, the business appraiser, waits patiently, sometimes for years, for that one perfect pitch, the fat pitch that Buffett talks about. Where they have done the work, they know the value, and the price is ridiculously low. They then have the confidence to swing for the fences. Over a lifetime, a handful of these decisions is all it takes to build substantial wealth. Your ability to perform an independent stock valuation is the single most important technical skill in your journey towards financial independence. It is what transforms investing from a gamble into a disciplined business enterprise, where you are systematically buying assets for less than they are worth. Even with a pure analysis and a solid valuation, a powerful enemy lies in wait, ready to sabotage your decisions at the very last moment. This enemy is a flaw in the wiring of our own minds, a cognitive glitch that has cost investors trillions of dollars. It is the reason why Buffett's process is so rigidly structured. This third pillar is about building a psychological fortress against anchoring. Anchoring bias is the subconscious human tendency to rely too heavily on the first piece of information offered, the anchor, when making decisions. Once an anchor is set, we adjust our estimates and judgments from that point, but we almost always adjust insufficiently. In finance, the most powerful, immediate, and dangerous anchor is the current stock price. It seizes control of our perception and frames all subsequent information. Buffett's method of valuing first and looking at the price second is not just a good habit. It is a powerful antidote, a specifically engineered countermeasure to this destructive mental flaw. And there is no greater historical example of the devastating power of anchoring than the dot-com bubble of the late 1990s. During that period of market mania from roughly 1998 to early 2000, the world seemed to be reinvented daily by the internet. Companies with .com in their names, many with no revenue and no profits, were coming to the public market and achieving astronomical valuations. A company like Pets.com or Webvan became a household name overnight. Their stock prices soared, doubling, tripling, quadrupling in a matter of months. These soaring prices became powerful anchors in the minds of millions of investors. A stock would debut at $20, run to $80, and then pull back to $60. An investor anchored to the $80 high would perceive $60 as, quote, cheap, a bargain. They wouldn't ask, what is the intrinsic value of this business based on its future cash flows? They would ask, how can I get in on this stock that was just at 80? The anchor of the recent high price completely short-circuited any rational attempt at stock valuation. Meanwhile, Warren Buffett was on the sidelines, and he was being openly mocked. He was called a dinosaur, a relic from an old economy who, quote, didn't get it. But Buffett wasn't anchored to the market's sky-high prices. He was anchored to his 70-year-old principles of business valuation. He looked at these dot-com darlings and he saw what they were. Speculative ventures with no history of earnings, no clear path to profitability, and no durable competitive advantage. His independent appraisal, his calculation of intrinsic value, showed that most of these companies were worth little to nothing. The market was offering to sell him a speculative story for $1 billion, but his analysis said the story was worth zero. The gap wasn't a margin of safety, it was a chasm of insanity. He refused to participate. His refusal to be anchored by the market's manic pricing saved his investors from the catastrophic crash that followed. When the bubble burst in 2000 and 2001, those same high-flying stocks collapsed. Pets.com went from a high of over $11 a share to bankruptcy in less than a year. Webvan, once valued at over $1 billion, went bust. Trillions of dollars of speculative wealth evaporated. Buffett's patience, his disciplined refusal to anchor to the narrative of the new economy, was vindicated in the most brutal way imaginable. His psychological fortress held strong against the greatest tide of market mania in a generation. To truly understand why this fortress is so necessary, we must dive deep into the behavioral finance behind anchoring. The concept was first identified in a series of brilliant experiments by the psychologists Daniel Kahneman and Amos Tversky, the founding fathers of behavioral economics. In one famous study, they spun a wheel of fortune, marked with numbers from 0 to 100 in front of a group of people. After the wheel landed on a number, say 65, they would then ask the participants to estimate what percentage of African nations were members of the United Nations. The participants knew the number on the wheel was random and had no connection to the question, yet their answers were profoundly influenced by it. The group that saw the number 65 gave, on average, a much higher estimate than a group that had seen the wheel land on the number 10. The random number served as a cognitive anchor, a starting point from which their brains adjusted, and they adjusted insufficiently. This happens on a neurological level. When your brain is presented with a number, it latches onto it. The prefrontal cortex, the part of your brain responsible for complex decision-making, uses this initial number as a reference point to save mental energy. It's a cognitive shortcut. When you look at a stock price, that number is immediately seared into your brain as the primary reference point. A price of $500 for Tesla stock becomes the anchor. A price of $20 for a forgotten industrial company becomes its anchor. Every subsequent piece of information you receive is then interpreted in relation to that anchor. This is why a stock that falls from $100 to $50 can feel cheap to someone anchored to the high, even if its intrinsic value is only $10, making it still wildly expensive. Conversely, a stock that has risen from $10 to $20 can feel expensive to someone anchored to the low, even if its true value is $50, making it still a tremendous bargain. Buffett's method is a genius piece of psychological engineering because it denies the brain that initial contaminating anchor. Your anchor becomes your own calculated intrinsic value, a number rooted in logic and analysis, not the market's ephemeral mood. So how can we build our own psychological fortress and protect ourselves from this powerful bias? We need a practical, applied mental model, a de-anchoring protocol, to use in our daily investment process. This protocol consists of 3 exercises. First, the historical anchor reset. If you accidentally see a price, or if you're analyzing a company you already own and are therefore anchored to your purchase price, you must consciously reset the anchor. Instead of the current price, force yourself to look at the company's price from 10 years ago, or its book value per share from 5 years ago, or its revenue per share. By deliberately introducing a different, less emotionally charged number, you can disrupt the power of the current price anchor and open your mind to a wider range of possibilities. Second, the value scenario simulation. Before you ever look at a stock's price, perform this thought experiment. Read your research, understand the business, and then write down on a piece of paper the answer to this question. If I had enough money to buy the entire company today, what is the maximum price I would be willing to pay for it? This forces you to think like a private owner and to name your price first. This number, your number, becomes your primary anchor. Then, multiply that number by 1.5 and write that down. Then multiply it by 0.5 and write that down. You have now created your own range of values, your own set of anchors, before the market has had a chance to provide its own. Third, the zero-based valuation. This is the purest form of de-anchoring. Imagine the business you are analyzing has just been created today. It has its current assets, its current earning power, its current competitive position, but it has never been publicly traded. There is no stock price history. There are no charts. Your job is to be the investment banker who takes it public for the first time. Based purely on its fundamentals, what would be a fair price to ask for a share of this company? This exercise forces a state of complete cognitive purity, where your valuation must stand on its own, without the crutch of any prior market data. The path of the 99% is a graveyard of decisions destroyed by anchoring. The most common and tragic manifestation of this is the behavior of catching a falling knife. An investor watches a popular stock, maybe a former market darling, go from $200 down to $100, then to $50. Anchored to the former high of $200, the price of $50 seems like an incredible bargain. They think it's 75% off its highs. It has to be a good deal, so they buy and they feel smart. But then the stock continues to fall to $30, then to $20. They are confused and angry. What they fail to realize is that the anchor of $200 was a mirage created by a period of market euphoria. The company's underlying intrinsic value, due to deteriorating business fundamentals, might have only been $10 per share all along. They weren't buying a 75% discount. They were paying a 400% premium. They anchored to a past price, not to a present value. The same destructive logic applies in reverse for buying the dip on a stock without a firm valuation anchor. The phrase itself is meaningless without context. A dip from an absurdly overvalued price to a merely very overvalued price is not an opportunity, it's a trap. Without an independent calculation of intrinsic value to serve as your guide, you are simply guessing, using irrelevant past prices as your only map. This is why so many investors who bought into collapsing companies like Enron, WorldCom, or Lehman Brothers on the way down were completely wiped out. They were anchored to the illusion of past glory, not the reality of present value. The direct financial connection of mastering this psychological defense is the preservation and compounding of your capital. Anchoring bias is a systematic wealth destruction machine. It lures you into overpaying for glamorous assets at the peak of a bubble and frightens you away from solid businesses when they are temporarily out of favor and trading at bargain prices. Your entry price on an investment is a critical determinant of your ultimate return. Let's say a business has an intrinsic value of $100 per share. If you, free from anchoring, buy it when the market panics and offers it to you for $50, you are positioned for a 100% return just for the price to revert to its fair value. Now, consider an investor anchored to the hype. They buy the same stock at $150, near its peak. For them to simply break even, the company's intrinsic value would have to grow by 50% to $150. They are starting their race with a massive handicap. The disciplined, non-anchored investor has the wind at their back, while the anchored investor is running into a headwind. Over an investing lifetime, this difference is everything. Building a psychological fortress against anchoring ensures that you are consistently putting the mathematical odds in your favor. It prevents you from making the single biggest unforced error in investing, letting the market's price dictate your perception of a business's value. It is a core component of the financial discipline required to beat the market over the long term. You have built the iron curtain, shielding your mind from the market's noise. You have mastered the art of the independent appraisal, creating your own anchor of intrinsic value. You have constructed the psychological fortress, defending your judgment from the bias of anchoring. Now, and only now, are you ready for the fourth pillar, the revelation. This is the moment you finally lift the veil and look at the stock price. But your relationship with that price is now fundamentally transformed. For the 99%, the price is a master, a source of truth that dictates their emotions and actions. For you, it is now a servant. It is simply a piece of data, an offer being made by the market, which you are now free to accept or reject based on the deep work you have already done. This pillar is about using the price as a tool, not a guide. It's where you compare your calculated value to the market's offered price and determine if a sufficient discount, a margin of safety, exists. And the perfect story to illustrate this powerful mindset is the tale of Warren Buffett and the great salad oil scandal. The year was 1963. American Express was a blue-chip company, a titan of finance, revered for its travelers' checks and credit card businesses. But one of its subsidiaries, a warehousing division, made a catastrophic mistake. They had issued warehouse receipts for millions of pounds of salad oil to a company called Allied Crude Vegetable Oil. These receipts were used as collateral for huge loans. The problem was, the salad oil didn't exist. The company's founder, a swindler named Tino De Angelis, had filled the giant vats mostly with water, with only a thin layer of oil floating on top to fool the inspectors. When the fraud was discovered, Allied Crude collapsed, defaulting on its loans. The financial world panicked. Wall Street assumed that American Express, having issued the receipts, would be on the hook for the massive losses, which were rumored to be large enough to bankrupt the company. The market's reaction was swift and brutal. The stock price of American Express was cut in half. Fear and panic gripped investors. The price, the anchor for everyone watching, was plummeting, signaling utter disaster. But Warren Buffett, then a young, relatively unknown fund manager, saw the situation differently. He had already done his homework on American Express. He understood the fantastic economics of the traveler's check business, a float where customers gave him money up front and he could invest it for a profit before they cashed the checks. He understood the powerful network effect of the credit card. His independent appraisal of these core businesses told him the company was worth far more than its pre-scandal stock price. The crucial question for him was whether the salad oil scandal would permanently damage these core businesses. So he went out and did the real work. He didn't just watch the stock ticker. He went to restaurants and travel agencies. He talked to clerks and customers. He observed. And what he saw was that people were still using the traveler's checks. Businesses were still accepting the credit cards. The brand, the moat, was intact. The scandal, while costly, was a one-time hit to a subsidiary, not a mortal wound to the main enterprise. He concluded that Mr. Market, in a fit of terror, was offering to sell him a magnificent business for a fraction of its true worth. The plunging price was not a signal of doom. It was a once-in-a-decade opportunity. He invested 40% of his partnership's capital into American Express stock, a massive, concentrated bet. It became his single greatest investment, and the returns were staggering as the market eventually came to its senses and the stock price recovered and soared. He treated the price not as information about the company's value, but as an offer from a manic-depressive business partner. And in 1963, that partner was terrified, offering to sell his shares at a ridiculously low price. Buffett, anchored to his own valuation, calmly and happily accepted the offer. This story is the perfect embodiment of the most important allegory in all of value investing, a mental model gifted to Buffett by his mentor, Benjamin Graham. It is the concept of Mr. Market. Graham asks you to imagine that you are in a business partnership with a man named Mr. Market. Every day, without fail, Mr. Market shows up at your office and offers to either buy your shares in the business or sell you his, at a specific price. The key to understanding Mr. Market is that he is emotionally unstable. Some days, he is euphoric. He sees nothing but a rosy future for your business and offers to buy your shares at a ludicrously high price. Other days, he is consumed by despair and panic. He sees nothing but trouble ahead and offers to sell you his shares for pennies on the dollar. Graham's crucial insight is this: Mr. Market is there to serve you, not to guide you. You are free to completely ignore him. You don't have to trade with him just because he shows up and quotes a price. But if you are a disciplined investor who has done your homework, you can use his mood swings to your advantage. When he is euphoric, you might consider selling him your shares. When he is depressive, you should gladly buy his. The psychological principle is one of complete emotional detachment and opportunism. The price Mr. Market quotes on any given day tells you nothing about the underlying value of the business. It only tells you about Mr. Market's current emotional state. The 99% of investors let Mr. Market's mood dictate their own. If he is happy and bidding prices up, they become happy and buy. If he is sad and selling things off, they become sad and sell. The master investor, the practitioner of the Buffett method, does the opposite. They use their own independent valuation as their guide, and they use Mr. Market's emotional quotes as an opportunity. The price is a servant, not a master. To operationalize this principle, you need an applied mental model for decision-making. This is the margin of safety calculation and action plan. This turns the abstract concept into a concrete, rules-based system. Step 1. Determine your hurdle. Before you ever invest, you must decide on your required margin of safety. This is the minimum discount to your calculated intrinsic value that you will accept. Benjamin Graham demanded a 50% margin of safety. Buffett is sometimes more flexible, especially for extremely high-quality businesses. For you, it might be 30% or 40%. This number is a core component of your personal financial discipline. Write it down. It is your law. Step 2. The 3-zone system. Now, when you finally look at the price, you will classify it into one of 3 zones based on your valuation and your margin of safety. Let's say your conservative estimate of a company's intrinsic value is $100 per share, and your required margin of safety is 40%. The green zone is any price at or below $60. This is your action zone. The price is offering a significant discount to your calculated value. This is where you buy, and potentially buy aggressively. The yellow zone is the space between $60 and $100. In this zone, the price is approaching fair value. This is a time for patience. You might hold if you already own it, but you would not initiate a new position. The red zone is any price significantly above $100. Here, the market is in a state of euphoria. Mr. Market is offering to buy your shares at a premium to their real worth. This is the zone where you would consider selling. Or at the very least, you would absolutely not be a buyer. Step 3. Write it down. The act of writing solidifies your thinking and enforces discipline. Before you click the buy or sell button, take out a piece of paper or open a document and write the following sentence. My conservative calculation of intrinsic value for Company X is your value. The market is currently offering a price of market price. This represents a margin of safety of your calculation percent. This falls into my green/yellow/red zone. Therefore, my predetermined action is to buy/hold/sell. This simple methodical process removes emotion from the final decision. It makes you an executor of your own well-thought-out plan, not a reactor to the market's noise. The antithesis to this disciplined approach is the pervasive and flawed belief in the price as a signal of quality. Most people, consciously or not, use the stock price and its recent trend as their primary piece of information about a business. They see a stock price that is rising and they conclude, this must be a good company, the market is smart, and it's telling me this is a winner. They see a stock price that is falling and they conclude, this must be a troubled company, I should stay away. They are conflating market sentiment with business fundamentals. This is a catastrophic error. The market is not always smart. In the short term, the market is a voting machine, tallying up the subjective, emotional, and often irrational opinions of millions of people. It is only in the long term that the market becomes a weighing machine, accurately assessing the true substance of a business. The investor who uses price as a signal of quality is doomed to be a momentum chaser, part of the herd. They will always buy after a stock has already had a huge run-up, and they will sell in a panic after it has fallen. They are perpetually late to the party and first to leave when things get scary. They have completely abdicated their responsibility to do their own thinking and have made the emotional, unstable Mr. Market their guide and master. The direct financial connection of mastering this pillar is the dual benefit of capital appreciation and capital preservation. The margin of safety is the central concept of value investing, and it is your ultimate financial shock absorber. It works in 2 ways. First, it provides you with downside protection. Your valuation of a business will never be perfect. The future is inherently uncertain. The margin of safety provides a buffer for error. If you value a business at $100 and buy it for $60, and it turns out your valuation was optimistic and the business is only worth $80, you still haven't lost money. You bought at $60, it's worth $80. You have a cushion. If, however, you had paid $90, your small error in valuation would have resulted in a loss. Second, the margin of safety provides massive upside potential. It is the source of your profits. The entire game of value investing is buying dollar bills for 60 cents. The 40-cent gap is your profit, which you realize as the market price eventually converges with the company's intrinsic value. By making the price your servant and only acting when a significant margin of safety exists, you are building a portfolio that is both resilient to shocks and pregnant with potential for high returns. It is the only logical way to navigate a market that is, by its very nature, prone to wild swings of emotion. You are no longer a victim of that volatility. You are its beneficiary. We arrive now at the final pillar, the one that ties everything together and transforms it from a clever technique into a lifelong philosophy. This is the practice of discipline, the conscious effort to institutionalize these mental models so they become an automatic, unshakable part of your investment operating system. A single good decision can make you money. A lifetime of disciplined decisions is what builds true, lasting wealth. This isn't about a one-time trick. It's about forging a permanent character of rationality and patience. It's about turning a difficult cognitive process into an ingrained habit, a fundamental component of your approach to capital allocation and executive decision-making. And the greatest testament to this lifelong practice is not a single transaction, but the 70-year intellectual partnership of Warren Buffett and Charlie Munger. Their relationship is a masterclass in reinforcing a rational investment process over an entire lifetime. Consider their monumental decision to invest in the Coca-Cola Company in 1988. By this point, Buffett was already a legend. The market was recovering from the crash of 1987, and Coca-Cola was a well-known, massive company. Its stock was not obviously cheap by conventional metrics. Many on Wall Street thought it was fairly priced, but Buffett and Munger, as always, ignored the conventional wisdom and did their own deep, independent work. They didn't start with the price. They started with the business. They looked at Coca-Cola not as a stock, but as a global institution. They analyzed its incredible brand, a symbol of happiness and refreshment in virtually every country on Earth. They studied its distribution system, a logistical marvel that placed its products within arm's reach of billions of people. They recognized its simple, unchanging product, which would not be rendered obsolete by technology. They calculated the immense and growing share of stomach it commanded globally. They did a private owner valuation, estimating the present value of the torrents of cash the business would likely generate for decades to come. Their conclusion was that Coca-Cola was a truly extraordinary business, arguably one of the best on the planet. Only then did they look at the price. The market was offering them the chance to buy this magnificent enterprise for what they determined to be a fair but not deeply discounted price. For a business of this quality, a fair price was a wonderful opportunity. Their discipline was not just in finding cheap stocks, but in recognizing that the immense, durable value of a truly great business was something the market often failed to appreciate fully. So Buffett, with Munger's full support, invested over $1 billion, buying up a huge chunk of the company. It was a massive bet, and it paid off spectacularly. The key here is the consistency of the process. 40 years into his career, Buffett was still rigorously applying the same fundamental principles. Value the business first, understand its moat, and only then compare that value to the price. Their partnership was a continuous feedback loop, a two-man system for reinforcing financial discipline, killing bad ideas, and maintaining rationality in the face of market pressures. This wasn't a one-off trade, it was another flawless execution of a lifelong practice. The underlying psychological principle at play here is the deliberate formation of habit, the process of achieving automaticity. Our brains are designed to automate tasks to conserve mental energy. When you first learn to drive a car, every action is conscious and difficult. Check the mirror, apply the brake, turn the wheel. After years of practice, you do it all automatically, without thinking. The complex sequence has been encoded in a part of your brain called the basal ganglia, which governs habits. The goal of a serious investor is to encode the correct investment process, value first, price second, into their basal ganglia. This is achieved through deliberate, repeated practice. Every time you force yourself to go through the methodical steps of building a valuation dossier, calculating intrinsic value, and applying your margin of safety rules, you are carving that neural pathway deeper. Eventually, the process becomes second nature. When you hear a hot stock tip, your automatic response is not "what's the price?" but "what's the business's moat?" When the market is crashing, your ingrained habit is not to panic, but to calmly pull out your watch list of great companies and check to see if Mr. Market is offering any bargains. By turning your investment process into a deeply ingrained habit, you bypass the need for heroic feats of willpower during moments of high stress and emotion. Your discipline is no longer a choice you have to make, it is simply who you are. It's an automatic response, a cognitive reflex that protects you from your own worst emotional impulses. To build this automaticity, you need a guiding document, a constitution for your investment life. This is your applied mental model, the investor's policy statement. This is a personal document that you write for yourself and review regularly, especially during times of market turmoil. It should contain 4 key sections. First, my circle of competence. In this section, you explicitly list the industries and types of businesses that you understand well enough to analyze. You also list the areas you will avoid. For Buffett, it was technology for many years. For you, it might be biotechnology or complex financial derivatives. This statement prevents you from straying into areas where you are likely to make mistakes. Second, my valuation methodology. Here, you state precisely how you will approach the task of stock valuation. Will you use a discounted cash flow model? An earnings power value calculation? You commit to your analytical tools in advance so you are not tempted to invent new, looser justifications for a stock you have fallen in love with. Third, my margin of safety rule. Define your non-negotiable discount. Is it 30%, 40%, 50%? Write it down. This is your personal law for buying. Fourth, my selling criteria. Just as important as knowing when to buy is knowing when to sell. Define the conditions. Is it when the price has risen to 20% above your high estimate of intrinsic value? Or when the underlying business fundamentals have deteriorated? Or when you find a dramatically better opportunity? Having these rules written down in a calm, rational moment will be an invaluable guide when you are in the heat of a difficult market decision. This document is your shield against your own emotional weakness. It is the constitution that governs your financial life. The antithesis of this pillar, the path of the 99%, is a phenomenon known as strategy drift. This is the common tendency for investors to have a plan, but to abandon it the moment it is tested by market volatility. They might call themselves a value investor during a calm market. They buy solid, profitable companies at reasonable prices. But then a bull market rages, and a new, exciting technology sector starts to soar. They see their neighbors getting rich on speculative stocks, and the fear of missing out becomes unbearable. They abandon their value strategy and start chasing momentum, telling themselves, "This time it's different." They have drifted from their process. Conversely, in a brutal bear market, their plan might be to hold their quality stocks through the downturn, but as prices fall day after day, the emotional pain becomes too great. They abandon their plan and sell everything near the bottom, locking in their losses. They lack a codified process, an investor's policy statement, to anchor them. Their strategy is fluid, constantly changing in response to the market's emotional weather vane. They are a ship without a rudder, and they are destined to be crashed upon the rocks of either euphoria or despair. This lack of a consistent, disciplined process is the primary reason for the vast gap between the theoretical returns of the stock market and the actual returns realized by the average investor. The direct financial connection of this final pillar is the achievement of the ultimate goal, financial independence. Consistent, disciplined application of a rational investment process is the only reliable path to building significant wealth over the long term. Lucky stock picks might create fleeting riches, but a sound process, applied relentlessly over decades, builds fortunes that last for generations. Every pillar we have discussed, the iron curtain of ignorance, the art of the independent appraisal, the psychological fortress against anchoring, and the revelation of the price as a servant, is a component of this master process. When you internalize this system and make it a lifelong habit, you transform investing from a source of stress and confusion into a systematic, almost serene, wealth-building enterprise. Your portfolio becomes a collection of ownership stakes in wonderful businesses that you understand deeply, bought at prices that provided a significant margin of safety. This portfolio will be resilient in downturns and will compound its value powerfully over time. This single, foundational habit of valuing the business first and looking at the price second, when practiced with unwavering discipline, is the engine that will carry you toward a future of financial freedom. It is not just the secret to never overpaying for a stock, it is the blueprint for a life of rational, successful, and independent investing. You have made a significant investment of your time and attention, and in doing so, you have acquired a powerful mental tool. You now possess the blueprint for the single most important discipline in all of investing, the iron law of valuing a business first, completely independent of its price. This isn't a tip or a tactic. It is a complete mental operating system for asset allocation. It is the psychological shield that protects you from the market's most dangerous traps, from anchoring, from herd behavior, from the emotional roller coaster of fear and greed. By making this two-step process your own, you have fundamentally shifted your relationship with the market. You are no longer a passive price taker, a victim of the day's volatility. You are an active business appraiser, a rational allocator of capital who uses the market's moods as an opportunity, not as a guide. This is the foundation upon which all great investment fortunes are built. But it is crucial to understand that this powerful model is one critical node in a larger, interconnected network of thinking that makes up the complete Buffett-Munger system. Knowing how to determine what a business is worth and when to buy it is a monumental advantage. However, it is only one part of a larger map. How do you know which businesses are even worth analyzing in the first place? How do you define your circle of competence? What is the right way to think about diversification versus concentration? And just as importantly, under what specific conditions should you sell a wonderful business you bought at a great price? Each of these questions is governed by its own powerful mental model, and they all work together, reinforcing one another to create a seamless latticework of rational decision-making. You have just mastered a cornerstone, but the cathedral of financial wisdom is vast. The video that is now appearing on your screen is not a random suggestion. It is the next piece of that map. It is the link that connects the discipline of buying right to the broader strategy of long-term portfolio management. It addresses the next logical question that arises once you've mastered the art of the purchase. Think of what you've just learned as the powerful engine of a race car. But an engine, no matter how powerful, is useless without a chassis, a steering system, and a skilled driver who knows the whole track. The knowledge in the video before you is that next critical component. It is the piece that will integrate today's lesson into a more complete, more robust, and ultimately more profitable investment framework. This is the point where most people stop. They learn one interesting idea and they are satisfied. But the journey to true financial independence is not for tourists. It is for builders. It is for those who are committed not just to collecting random pieces of knowledge, but to assembling a complete mental toolkit, a full arsenal of models for making consistently superior decisions. The choice you have right now is simple. It is the difference between an amateur and a professional. Amateurs look for tips. Professionals build a complete, integrated system. The click you are about to make is not just a click to watch another video. It is a conscious decision to continue your ascent. It is a commitment to completing your mental arsenal, continue building, complete the map.